Have you ever wondered what an adjusting entry is? Hello, my name is Adam Hutchinson. I currently study a Bachelor of Business at the University of Technology, Sydney, and today I will be explaining the accounting concept of adjusting entries and the processes used to adjust entries. Firstly, it is good to understand what a journal entry is. A journal entry is a recording of any transactions conducted in a business. They provide a systematic means of analysing how transactions affect the business's financial position and are used to create financial statements. An adjusting entry is a journal entry made at the end of an accounting cycle to bring revenue and expense accounts up to date. This is done under an accrual basis of accounting, which records revenues and expenses when they are incurred, not when cash is received. Adjusting entries can be revenues that have been earned but not recorded, accrued revenue, revenues already recorded but not earned, deferred revenue, expenses incurred but not recorded for, accrued expense, or expenses recorded but not yet paid, deferred expense. Time for the processes of adjusting entries. The first example is of accrued revenue, which is when a company receives interest of $10,000 on a bank deposit for the month of December, finishing on the 3rd of June. Their accounting year ends on the 31st of December. The journal entry would be to debit interest income receivable $10,000 and credit interest on bank deposit $10,000. On the 3rd of January, the adjusting entry will need to make, which will be to debit bank interest income $10,000 and credit interest income receivable $10,000. A deferred revenue example is if a company sells 12-month subscriptions to a monthly magazine in October and they receive $1,200 for 12 subscriptions. The journal entry would be to debit cash and credit unearned subscription revenue. In February 28, the company must then adjust the entry to account for 5 months earned revenue. They must debit unearned subscription revenue and credit subscription revenue. An incurred expense example is if a company has a daily payroll of $1,000, pays its employees Saturday for work Monday to Friday, and prepares its financial statements on April 30, which is a Friday. The journal entry on April 30 would be to debit salaries expense $5,000 and credit salaries payable $5,000. When the company pays its employees, the adjusting entry on March 1st would be to debit salaries payable $5,000 and credit cash $5,000. Third expense example is if a company purchases a 12-month general liability insurance policy on March 1st for $36,000. They would make the journal entry to debit prepaid insurance for $36,000 and credit cash for $36,000. They prepare financial statements on March 31, meaning they would have been covered for 1 month insurance. So they would divide $36,000 by 12 and get $3,000. The adjusting entry on March 31st would be to debit insurance expense $3,000 and credit prepaid insurance $3,000. And that is the accounting concept of adjusting entries. Thank you for watching my presentation.